Hey there, it's Casey Newman here from TaxSaleAcademy.com. Thank you so much for joining me for this week's tax sale question segment. This week's question comes to us from Caroline. Caroline says, I'm just learning about this tax sale business. It just doesn't seem fair. Can somebody really lose their house if they just happen to forget to pay their taxes? So Caroline, first off, thank you so much for submitting your question. If anybody else watching this video has a question, feel free to leave that question below any of our videos here on YouTube, and we will definitely respond. Now, Caroline, your question was a concern that many people come up with that, as you'll see, isn't really a factor. That's not just a fair assessment of this business. Now, before I discuss the process, I do like to remind people that real estate taxes are a necessary evil, right? Nobody likes to pay taxes. I certainly don't. Now, real estate taxes, however, provide the funds required for many, many amenities, including a number that you might use every single day without even realizing they're paid for by real estate taxes. We're talking roads, sidewalks, drainage areas so you don't flood out, schools, law enforcement, fire departments, bridges, libraries, parks, and so many other things. Now, the budgets for these services and these amenities are set by the local governments with the expectation that people will pay their property taxes on time. When enough people fail to pay their property taxes on time, the government, they just simply cannot provide these necessary services. So there's a system, the tax delinquent system, that handles these types of issues when people fail to pay on time. There are three primary ways to handle late taxes. We have the tax lien system, the tax deed system, we have a hybrid system that's kind of a mix between the two. Now, I'm not going to go into all these specifics on each one of these because I have lots of different videos that explain those here on my YouTube channel, but I'm going to touch on those very briefly to put everything together for everybody watching this. So obviously, a tax bill gets sent out yearly or twice a year in some states. The owners know the amount of this tax bill well ahead of time, and they know the date that it's also going to be due. If the taxes are not paid by that date, they are going to be considered as delinquent. And when this happens, there are many different reasons that this could happen, right? But even the most successful people can simply overlook their taxes. So they'll usually get a notice that basically says, hey, your taxes are late. It's time to pay those taxes. And by the way, you might owe us a few extra bucks because you forgot to pay on time as some sort of late fee. From there, eventually, a lien is going to be attached to the property, a tax lien. This could be done a month or two after the taxes went late, or it might take even longer. Now, after that, you're going to have a processing fee in order to get that lien redeemed, that kind of stuff. And the lien in tax lien states can be sold to a third-party investor. In a tax deed state, the lien is going to be held by the county. So now your property has a lien that's tied to it. And that property cannot be sold with a clear title without clearing off that tax lien. So at this point, you'll have to redeem the lien to prevent the eventual loss of your property. To redeem the lien, all you have to do is pay the back due taxes, the processing fees, any interest, that kind of thing. Once you pay that, that lien comes off the property, and it's just like you paid the taxes. No more worry about it. Now, the longer you wait, the worse it can get because that tax lien might be earning interest at 15, 20%. So obviously, that number is going to start to climb on what you owe. At some point, depending on the state, the lien will be moved into a tax foreclosure status. So just like a mortgage lien can be foreclosed if you stop paying your mortgage, that tax lien can also be foreclosed. Again, the timeline varies, but that tax lien, whether it's held by a third-party investor, like somebody watching this video, or if it's held by the county in a tax deed state, it can eventually be foreclosed. So prior to this point, the property owner will likely have received many, many notices. In some states, they're required to send upwards of 15 notices that will have been mailed by first-class mail and certified mail, plus postings on the property and legal ads in the local newspaper. So it's not like the owner doesn't know what's happening. Additionally, they'll have had years to have come up with that redemption amount by saving money, by borrowing money, or even selling that property and then paying off those taxes at the closing of that transaction. So you need to understand that at this point, these specifics can kind of vary from one state to the next, just depending on the system that is used. But usually at this point is where the owner of that property can lose ownership. And we're talking years into this process, okay? It can be claimed by the tax lien investor who forecloses that tax lien, or the county will sell the property outright at what is called a tax deed auction or a tax deed sale. Now, it should be noted that a few states will have one final window when those delinquent taxes can be paid and the property redeemed. But at that point, the fees have risen substantially from what they start off with at that initial tax bill. So, Caroline, hopefully this helps you kind of put the tax sale business into perspective. It's not like somebody just forgets to pay their taxes today and they lose their property tomorrow or anything like that. It's a very, very lengthy process before somebody actually loses their property. And yes, they do have to pay late fees and stuff like that, but it's just the same as paying a mortgage or any other type of lien or any other type of bill for that matter. If you don't pay it on time, you are eventually have to deal with those consequences. And again, the taxes, they go to help out the community. They go to help out the safety of the community, to make sure the roads are there, law enforcement, all that good stuff. It's a necessary evil, but it's a system where the tax lien investors, the tax deed investors can actually help out the betterment of the community. If somebody fails to pay their taxes on time, that's where we step in. We invest. And not only do we make money for ourselves, of course, that's what we want to do, but secondly, to that, we help out the community because we put that money back into the budgets and we put those properties back into the hands of a responsible citizen who will pay the taxes on that property for years to come. That way, again, they can fill those budgets. They can pay for law enforcement. They can pay for fire and all that good stuff that we come to rely on each and every single day. So Caroline, again, hope this answered your question. If you and yourself are looking to learn more about investing in tax-default real estate, just head on over to TaxSaleAcademy.com. A great resource to help you get started is this book right here, the Tax Sale Playbook. The book itself is free. I want to ship you an actual physical copy of the book, not an ebook or anything like that. Just cover the shipping costs. It's less than $5 if you're in the U.S. Again, that's TaxSaleAcademy.com. Hey, take care, folks. See you next time. Bye-bye.